Today, we're diving into the invisible world that powers every single piece of tech you own. It's the high-stakes, high-reward world of semiconductor design. And we're talking about a massive $35 billion acquisition that's totally reshaping the entire landscape. So let's break down what it all means.
So here's what we're going to cover. We'll kick things off by figuring out who this chip blueprint company even is. Then we'll get into the details of that massive $35 billion power move. After that, we'll map out the whole competitive landscape, this high-stakes race they're in, look at the roadblocks they're facing, and wrap it all up with what the analysts think. Who's really set up to win here?
All right, first up, the chip blueprint company. And really, these are the invisible architects behind pretty much every smart device you own. You know, every powerful chip, the one in your phone, your car, those big AI servers, it doesn't just appear. It starts as an incredibly complex digital blueprint. And companies you've heard of, like Apple, NVIDIA, Qualcomm, well, they all rely on super specialized software to design these microscopic marvels. A key player here, maybe one you haven't heard of, is a company called Synopsys.
Right, so the industry has a name for this stuff, electronic design automation, or just EDA. And the best way to think about it is like this. Imagine a microchip is a skyscraper with billions of floors, each floor being a transistor. Well, EDA is the super advanced architectural software you'd use to design and test that entire skyscraper before you even break ground. It's the absolute foundation of all modern electronics.
Okay, and that brings us to the main event, a $35 billion power move that really shows just how critical this blueprint software has become. Yeah, look at that number, $35 billion. That's the price tag Synopsys paid to buy Ansys, another giant in a closely related field, simulation software. And look, this isn't just a big number. It's a huge statement about where the future of chipmaking is headed.
And this all just went down. I mean, if you look at the timeline, after months of uncertainty, it even caused some of Ansys's customers to hit pause on their orders. The whole deal officially closed on July 17, 2025. Just like that, a new industry titan was born.
So why is this deal such a game changer? Well, it's pretty simple when you break it down. Synopsys, they master the art of designing the chip's digital blueprint. Ansys, on the other hand, is the absolute gold standard for simulating how that chip will actually behave in the real world. You know, how does it handle heat? What about physical stress? By putting these two together, Synopsys can now offer the whole package. They can design the chip and then perfectly test it in a virtual world, all under one roof. That's a huge deal.
Now, an acquisition this big doesn't happen in a vacuum, right? It's a massive strategic move in a super competitive, high-stakes race between just a handful of dominant players.
Okay, so if we put Synopsys head-to-head with its main rival, Cadence, you start to see the picture. Before this deal, you could argue Synopsys had the breadth, while Cadence had more depth in certain areas like verification. But look at that last row. That's the key. After buying Ansys, Synopsys has basically plugged its biggest portfolio gap. Meanwhile, Cadence is now missing that deep, real-world simulation piece. That is a fundamental strategic shift in this market.
Of course, it's not just a two-horse race. You've got these niche dominators, too. There's ARM Holdings. They're the ones licensing the core designs for the CPUs and GPUs that power pretty much every smartphone on the planet. And then you have Siemens EDA, which owns a mission-critical tool called Caliber that's used for physical verification. Each of these companies has carved out its own essential and very profitable corner of this whole ecosystem.
But who's got the momentum? Well, if you look at recent growth, Cadence has actually been on a tear, showing 20% year-over-year revenue growth. Synopsys is at a very respectable 10%, while Siemens' Digital Industries division has actually seen a bit of a decline. So yeah, the race is definitely still on.
But at the end of the day, after this massive Ansys deal, the analyst consensus is pretty clear. As they put it, no competitor matches Synopsys' combined EDA plus IP plus simulation scope. That says it all, really.
But, you know, being the biggest doesn't mean it's all smooth sailing from here. Synopsys, and really the entire industry, is facing some pretty significant headwinds and some high hurdles.
Analysts are pointing to four big risks here. First up, just the sheer task of integrating a $35 billion company. That's a monumental challenge, merging cultures, products, everything. Second, you've got U.S. export controls on advanced tech going to China. That's a major wildcard. Third, the chip market has always been famous for its boom and bust cycles. And finally, there's this growing threat from something called RISC-V. It's an open-source chip architecture, basically a free alternative to proprietary designs like ARMs, and it could totally disrupt the whole business model.
And just to put that geopolitical risk into perspective, China accounts for something like 15% of Synopsys' revenue. So any new restrictions on selling these advanced EDA tools over there could hit their bottom line directly and maybe even push customers towards homegrown Chinese competitors.
Okay, so with all of that in mind, the huge acquisition, the intense competition, and all those risks, what's the final verdict from the experts who track this stuff for a living?
Well, the final scorecard really puts Synopsys right at the top. They get a 9 out of 10 for their competitive moat, that's how defensible their business is, and an 8 for their growth outlook. They're clearly positioned as the leader, with Cadence as a really strong number 2.
And the thinking behind those rankings really boils down to this. Synopsys is the top pick because of its unmatched scale and its lead in using AI to help design chips. Cadence is still a beast in its specific niches like verification. ARM is basically a pure bet on the demand for AI chips. And Siemens, well, it's a much more diversified, slower growth industrial company.
And what does that mean for an investment strategy? Well, it translates into a pretty clear recommendation. Analysts suggest that if you're investing in this sector, you give Synopsys the biggest slice of the pie, which reflects its top-ranked position. Cadence gets the next biggest chunk, and then you'd have smaller, more tactical positions in ARM and Siemens to capture what they bring to the table.
And all of this leaves us with one big question. Chips aren't just in our computers anymore. They are literally becoming the bedrock of everything in our future, from AI to automation. Synopsys just made a $35 billion bet that it can own the master blueprint for that future. The only question left is, will that bet pay off?